This is Cameron Jones with NFP. I also have along with me presenting here today Kellen Foley, the CFA charter holder and on our investment committee here at NFP. And really our goal of today is so a quick background on NFP is we are a retirement plan consulting firm. So some of the insight we bring to you today comes from our experience with clients in regards to setting up an investment lineup for their defined contribution plans. So specifically, we're going to be covering the topic of target date funds and really the liability associated with those, as they are quite different than any other investment option within your defined contribution plan lineup. So a big reason these are a huge area of focus for the Department of Labor and they do draw a lot of liability is because that is actually where the majority of the assets are in the retirement defined contribution world, and we see continued growth in that through things like automatic enrollment and auto escalation going to a QDIA or qualified default investment alternative. And this is really helping participants help themselves through plan design, but with these auto features, the assets are actually directing towards these target date funds or set it and forget it type options. And to give a little background, just basic context of what a target date fund is, for those of you that don't know, is it's a portfolio of underlying mutual funds that starts with a high equity exposure and lower fixed income exposure and becomes more conservative as a participant gets closer to retirement. So it's meant to be put 100% of your assets into this option, and it'll be managed down more conservative over time through what we call a glide path as we get closer to retirement. One thing about target date funds is while they are the most widely used investments and where we see a projected 70% of total assets going to with it by the year 2020, is they're quite often the most widely misunderstood, as there's quite a difference in the different types of target date funds out there. If you actually look at this chart here, you'll see the calendar year range of returns for the 2010 funds. So you'll see in the year 2010, this blue bar represents the best case return, and then the orange is the worst of all the different target date fund series in the universe. And the gray is really the difference between the two. So you had some 2010 funds in the year 2010 performing with a difference of about 8% here. In 2009, we saw even larger difference. 2008, we saw 31% difference from the best performing
Click on the top
fund to the worst performing fund. In 2008, 2006, we saw the same thing. So the idea here is that not all target date fund series are created equal. They're actually quite different as far as the underlying construction of the portfolios and the risk posture that each target date series is actually taking on through their glide path. So because of the unique differences in this, that's not necessarily easy for participants to see just through looking at the name of the end of the fund, right? These are all funds that end in the year 2010. Is to actually talk about how can we shed some light on that, do an additional layer of due diligence on them, and really provide you with a framework to evaluate your plan's target date fund series. So Kelly, at this time, I'd like to poll everybody to see who currently is actually utilizing a target date fund investment option within their current plan lineup. Are you able to bring that to the forefront, Kelly? All right, so it looks like we've given everybody a chance to respond, and it looks like 100% of everybody on this call is currently using a target date fund series in their lineup. So glad this is very relevant to the group on the call today, and so hopefully this framework for target date fund analysis you'll be able to take back to your own committee. So now I'm going to hand it over to Kellen Foley, the CFA charter holder, who's really a big part of the brainchild behind coming up with some of the criteria you should be considering for your target date fund analysis.
All right, thank you, Cameron. When
Cameron asked me to be a part of this. I was really excited because this is a area that I'm very passionate about, and it's an area our firm is very passionate about because just like everything else in the retirement plan industry, things are constantly changing, and we feel like target date funds, currently right now don't get the attention that they deserve from a lot of parties, and we're hoping to kind of bring a little bit more light here into what needs to be considered from a plan perspective, from a participant perspective, from an advisor perspective, et cetera. So as Cameron mentioned, our goal today is really to set that foundation for everyone and provide a framework so that you can go back and evaluate the target date series that you've selected in your plan, which, from that poll, everyone does currently have a target date series. So how do you go back now and ensure that the one you have in your plan is a good fit? And then kind of what's the next steps in terms of documenting that process and then possibly looking at other alternatives if the current solution is not a right fit. So with that being said, we'll move forward here and talk about what these 3 steps really are. First, we wanted to talk about what are your duties as fiduciaries, and we'll mention the Department of Labor tips here, which hopefully everyone is familiar with, that were released in 2013, that laid out exactly what a fiduciary needs to be doing to evaluate their target date series. Next, we'll go into what are the prudent steps to follow to evaluate that target date series in your plan. And lastly, bring up custom solutions, which are an emerging area of the market that would allow you to take a slightly different approach and possibly come up with a solution that is a better fit for your plan. So we'll jump into the first section here, fiduciary duties. I mentioned the Department of Labor tips. Hopefully everyone on the phone call here is familiar with these tips, has read the tips. If you haven't, I strongly recommend that you do. The full fact sheet is available on the Department of Labor's website. I'll mention it was released in 2013, and it said a lot of really good things. The quote that I have here on the screen is very general. Plan fiduciary should engage in an objective process to evaluate the prudence of any investment option under the plan. Hopefully you're doing that already with your core funds. This particular piece went into more depth related specifically to target date series. And this slide here lays out exactly what those recommendations were. So first and foremost, the Department of Labor says you should align the target date fund with your participant characteristics. That's the first and foremost consideration before anything else that you consider. And this sort of flipped a traditional process on its head. A lot of plans look first to performance, whereas the Department of Labor here is saying, while performance and fees are important, the fit is the most important. So we'll spend a lot of time talking through this. They want you to understand the underlying investments that comprise a target date series. So a target date fund is what's called a fund of funds, meaning the underlying investments within a target date series are mutual funds in and of themselves, and they want you to take kind of a step further beyond just the overarching target date and look, are the underlying investments quality as well? So really look under the hood. As always, review fees and investment expenses, extremely important. Consider custom or non-proprietary options. Again, that will be our last topic of discussion there, but a very directed point from the Department of Labor to consider if those would be a better fit than something off the shelf. Develop effective employee communications. That goes without saying, again, with most funds, but target dates, due to their complexity, probably a little bit more important. And then lastly, but certainly not least, document the process. No matter how you're going through this, you really need to document that you're doing all of these things. That way, if the Department of Labor ever does come knocking on the door, you have documentation that you've gone through this process and have a solid foundation for the reasoning behind selecting the target date fund you have in your plan. So I mentioned going through a little bit more high level, aligning your characteristics of your participants with the target date fund. How exactly do you go about this? From a high level standpoint, what are the characteristics of participants that you want to consider? There are plenty, but the main ones are probably salary level, savings rates, account balances, and withdrawal patterns. How are your participants behaving in the plan? Are they generally, low-income earners or high-income earners? Do you have a mix of both, as most plans do? Are they generally low savers, high savers, in the middle, or a mix? Plan balances, by the time participants retire, do they have high account balances? Or is this not really the primary savings vehicle for your participants? Is there a defined benefit plan that they rely on more heavily? And withdrawal patterns, same sort of thing. Are participants taking their money out as soon as they reach retirement age? Or do you tend to see participants keeping the money in the plan for years beyond their retirement age? So good things to consider there, and then match that to your target date fund strategy. Glidepath. Cameron mentioned what a Glidepath was, but as a review, a Glidepath describes the transition that a participant experiences in a target date series from higher risk assets when they're younger, mostly defined by stocks, to lower risk assets as they age and get closer to retirement, which are mostly defined as bonds. But glide paths are very different from one another. How does this transition take place? If you have a lot of high savers in your retirement plan, people that are generally deferring, let's call it 10+%, your glide path should probably reflect that high savings rate, meaning it should be less aggressive or more oriented towards fixed income or bond investments relative to stocks to reflect that people saving at a higher rate don't need to take on as much risk. So that's where initial kind of how do we match these together. Asset classes, what sort of asset classes are participants exposed to within the target date series? Do you have emerging markets exposure, high yield bond exposure? These aren't necessarily good or bad things. It's just matching it up to what you want to have in your plan. Component fund strength, we mentioned that before. Make sure the underlying investments are strong. And then lastly, fees as well. So this is kind of a basic framework for how you compare and make sure that your target date fund matches the goals of your plan participants. So now we've laid out, what are your duties as a fiduciary? And it goes above and beyond, quite frankly, what you may think or what your experience has been in regards to other investments in your plan. And it is true. It is sort of a higher call of action that's needed with these target date funds. And as a result, the process needs to be a little bit more in-depth. So let's go through now what sort of steps can you take, what kind of framework is there to allow you to make sure you're kind of checking all these boxes. We have a 3-step process to allow you to select and monitor a target date fund for your plan. The first step we call suitability analysis. And in this step, you want to look at 3 main things. The funding adequacy of your participant base. So that goes back to like a savings rate discussion. Do you have high savers or low savers? And then participant tendencies. This is, those withdrawal patterns, or do you have a sophisticated employee base or a relatively unsophisticated employee base? How do you take those 2 characteristics around your demographics and match those to glide paths that match what you need as a plan? So that's step 1, finding the right fit target date series and glide path for your plan participants. Step 2 then dives into more qualitative considerations surrounding target date series. Three things we lay out here are, do you want active or passive underlying management? Do you want a single manager managing all the underlying funds within the target date series, or multiple managers managing the different asset classes? And then the asset class exposure I mentioned earlier. Do you want some of those non-core asset classes in there, commodities, maybe real estate, or do you want more just the core asset classes without some of those extended asset classes covered as well? And then step 3, finally, is the performance analysis. And I want to, it's really important. I mentioned earlier, performance is the starting place for a lot of people, and it really should never be. The most important thing is finding a fit from a suitability and qualitative standpoint. And then once you have different target date series that are a fit, now you can start comparing performance to narrow it down to one series that is a best option for your plan. And when you compare performance, it's important that it's not just performance that you're comparing; it's meaningful performance. And make sure it's risk-adjusted performance. Make sure you're considering style factors and the underlying funds. So we'll get into kind of all of this in greater depth. But this 3-step process here is a really solid foundation based off the tips from the Department of Labor to make sure that you're going through and considering all the factors that they want you to. So we'll spend some time here now going through each step. Step 1, the first item to consider is the funding adequacy of your plan. To put this in simple terms, the idea is it's prudent to de-risk sufficiently funded portfolios and imprudent to de-risk insufficiently funded portfolios. What that means is if you're a participant in a plan and you are saving, let's say 2% of your salary, clearly that's not a lot. It's going to be very difficult for you to reach your retirement goals by only saving 2% of your salary. And unfortunately, no one can invest their way to retirement, but you can try, and you need to try. So if you can't save enough, you need to be taking more risk in your portfolio in order to give yourself a chance to have that sort of money at retirement. So that's why it's imprudent to de-risk insufficiently funded portfolios. If you're not saving enough, you need to take on more risk. Now, vice versa, if you are saving enough, let's say 12% of your salary into your retirement plan, you don't want to be taking on as much risk. You're doing all the right things. Your emphasis should be more on preserving the capital that you have already saved versus exposing yourself to undue risk of principal. So this is sort of the whole idea. And then say, if you have a participant base that has a lot of high savers, it makes sense to match that with a conservative risk posture target date series. Whereas if you have a lot of high savers and you're in an aggressive target date series, a lot of those participants are going to be taking undue risk. And the same is true vice versa. If you have a lot of participants in your plan that aren't saving enough, it's more prudent to be in an aggressive target date series to allow those participants to have a chance to retire successfully. The next item are participant tendencies. This is more of the touchy-feely subjective side of it, but also very important. This is kind of their participant willingness to take risk, which is obviously a very important consideration. So withdrawal patterns, general investment knowledge, and then just risk tolerance levels. You can kind of see if a lot of your participants, younger participants are allocated heavily to cash investments. Maybe you have a generally risk-averse participant base. That could also, however, be an indication of just, lower investment knowledge overall, not kind of knowing what to do. But the same concept here. Look through your demographics and try to identify from a willingness to take risk standpoint which target date risk level, conservative, moderate, or aggressive, would be a better fit for the plan. It's a marriage of the ability to take risks, the funding adequacy, and the willingness to take risk here. So you match these together. In this example, let's say you determine that an aggressive target date series is a good fit. The next step is to say, okay, well, which target date series out there are aggressive, so I can narrow down this list of available options for my plan and start to go through some of the qualitative factors. Because the issue, unfortunately, is that glide paths vary tremendously, and Cameron mentioned this when he opened, but not every glide path is treated equally, and that's why we segment the universe into the 3 risk categories. So once you've identified your fit, now your job is to go ahead and look at all the different options that are available and narrow it down to glide paths that just fit your plan, or in this case, in our example, all the aggressive glide paths. And you can see here, just as an example, this is an image of all the different glide paths that exist out in the industry, and you can see that the most aggressive glide path at retirement has 65% equity exposure, whereas the least aggressive glide path has 15% equity exposure. So depending on which one you select, there's going to be a clear difference in investment performance over time for participants invested in either one of these. And that's why this fit discussion is so important. You need to make sure that the participant is a good fit along their glide path for their particular needs. All right, so we've identified the right fit now. The next step is to consider some of these qualitative considerations. So I mentioned, do you want active or passive underlying management? Maybe you want a mix of both, which is there's options available that have active and passive management. The investment type, proprietary funds or multi-manager, there's sub-advised approaches. There are a lot of different investment types out there. The asset class coverage to consider. So just some more items that you want to take note of before you narrow it down even further, because that's really the point here, is to narrow it down even further once you identify the fit. And then last is step 3, that performance analysis that I was referring to. And again, it's about meaningful performance. Make sure the metrics you're looking at are risk adjusted. It's good to look at benchmark-related statistics and peer group-related statistics, not just one or the other. Make sure you're considering style factors as well. Look at qualitative considerations, manager tenure, what's the fund expense, right? These are where some of these other things come into consideration. And look at it more from an institutional framework and really do due diligence beyond just, hey, what's the 5-year performance? That's not going to be as meaningful. The other important consideration that you might remember from the Department of Labor tips is that you need to dive under the hood and look not just at the performance of the target date funds themselves, but also the performance of the underlying funds that make up the target date series. So in this case, what you see on the screen here is, you look at the micro cap fund, the small cap growth fund, the international equity fund. All these are funds within the target date series. And it's important to make sure that these are quality investments as well, because after all, a whole is only as good as its parts. If the underlying investments within a target date series aren't quality, it's going to be difficult for the overall funds to be quality as well. Okay, so the last discussion item of the day here are custom solutions. And as a reminder, the Department of Labor said you should inquire if a custom non-proprietary solution is a better fit for your plan. So we'll talk about today, how do you do that? How do you make sure that you are considering custom solutions? How do you document that you've considered a custom solution? And how do you know if a custom solution is in fact a better fit for your plan or is it not? So to fully understand what a custom solution is, I think it's important to put it in the context of what a traditional or off-the-shelf target date solution is. And I would venture to guess that the majority of you have this traditional target date fund model. And the reason that's the case is because that's kind of been the norm for a long time in the industry. But because of the Department of Labor tips that were released, custom solutions are really evolving and moving down market. So previously, custom solutions were really reserved only for the mega plan space. And it was for plans, the Walmarts of the world that had the funds necessary to support that sort of customized solution. But like anything else, they're coming down market, and it's coming down market quickly as a result of the Department of Labor's oversight. So with that in mind, a traditional target date fund solution, what's essentially going on here is you're identifying the fit from an average participant perspective, right? You want to look at your average participant savings rate, your average plan balances, average withdrawal patterns, and average risk tolerances. And the reason why you have to boil everything down to an average is because there's only one glide path that you're selecting. So you're saying, okay, my average participant needs an aggressive glide path, as we determined earlier. That's great. So you pick a target date series that has an aggressive glide path, and that matches your average participant. Unfortunately, as you might suspect, while it fits your average participant, it might not fit all your participants, and it likely doesn't fit all your participants. So we'll get into the implications of that in a second. The other aspect of a traditional target date fund is that they're single investment manager, meaning the investment company that manages the target date series is the same investment company that manages all the underlying investments within the target date series. So, there's some potential advantages of having different managers involved instead of just one. So, think about your plan's core lineup, for example. I doubt that you have one fund company managing all the investments within your core lineup. However, in your target date series, you likely do have one company managing all the investments. So this is kind of trying to bring that more multi-manager feel into target date series, but the traditional off-the-shelf versions are still that single manager. So that's kind of the framework for where we've been. Now let's consider where the industry is going. Well, actually, I'll just reiterate for a second here that the two kind of big challenges with this 1.0 solution are the fact that there's just one glide path and one investment manager, traditionally. So because of this, the Department of Labor has, those tips that they released, and they said, really we recommend inquiring whether a custom non-proprietary solution would be a better fit. So they hit on those 2 points. Custom, meaning, a glide path that's better fit for your plan, and non-proprietary, meaning it's not your same fund company that's managing the target date series, it's managing all the underlying investments. So just consider that it's a good fit and document that you've done this. That's a really important aspect. So the first custom solution that I want to cover is what we call version 2.0. If traditional target date funds are 1.0, the first custom solution would be version 2.0. And here, the big difference is that instead of picking a glide path that already exists and trying to match that with your plan average, you actually create a glide path to fit your plan. So you're still looking at averages. You still have to boil everything down to an average. But at least in this case, you're creating a glide path that you know is a perfect fit for your average participant instead of picking something off the shelf that is as close as you can get, which unfortunately may not be close enough. The other aspect is that instead of having the proprietary structure, you actually utilize your plan's core funds to make up the underlying investments of the target date series. So what does that do? Well, that ensures that you likely have multiple managers, so you're less exposed to the liability of a single fund company. It also makes sure there's an independent manager selection. I'm sure many of you have an advisor on your plan, and this is where that advisor can, input their independent selection criteria and pass that through to the target date series, not just your core funds. So those are the two big differences that improve upon some of the structures of version 1.0. Now, to reiterate, this is a visual of all the off-the-shelf Glidepaths. So if you go through this fit process and you can't really find an off-the-shelf Glidepath that fits your plan, it just doesn't really get to all the criteria that you're looking for, this is where a custom solution might come into hand, where you can actually create a Glidepath just for you. And likely, in order to do that, that's where an advisor or some sort of third-party consultant can be really beneficial. And then I mentioned using the underlying fund. So take all the individual standalone funds in your plan, the mid-blend, the fixed income, the international equity, et cetera, and now put them together, put all those pieces of the pie together, and all of a sudden you create a portfolio in your target date series comprised of those independently selected investments. Unfortunately, this version 2.0 structure does introduce some new challenges which do need to be considered. There's 4 main ones, and I'll actually add a 5th here at the end. But the first one is that they're not unitized. What unitized means is that the fund itself is an actual fund. It has a daily net asset value that's reported to participants and has fact sheets and all the things that you normally associate with the simplicity of a regular mutual fund. A lot of these custom solutions aren't unitized, which makes it difficult from sometimes an implementation standpoint and an ongoing due diligence standpoint because of that fact. Now, there's ways to get around that, and we'll get there in a second. The second point, still just one Glidepath. So although it's a better fit than maybe a version 1.0, you still just have one, so you're still boiling everything down to an average in your plan. And if you have a diverse participant base, it's going to be impossible to, quite frankly, get one Glidepath that's a good fit for everybody. No portability across record keepers. This becomes an issue, if you're with a certain provider now, you go through all this work to create a custom solution, but then unfortunately, for pricing reasons or service reasons, you have to move to another record keeper and have to duplicate the same effort to have the same type of model custom target date solution. The fourth point, no access to funds outside the plan lineup. So while you're expanding your investment universe from version 1.0 here, you're still limited because you can't get access to funds that aren't included in your core lineup. And clearly that can be an issue, considering your core lineup typically doesn't have a lot of funds in it, which is a good thing from a core lineup perspective, but it might limit you here from a target date fund perspective. The fifth point that isn't on here, but I wanted to bring up, is that traditionally this version 2.0 structure is very costly. And it's costly because there's a lot of work involved. You typically have provider costs or consultant costs, and it can be too much for a lot of plans to handle that aren't, again, mega market. So just things to consider with this kind of version 2.0, but what's great is that there's a version 3.0 that's out, and we'll get into kind of the philosophy behind that right now. But the biggest thing I mentioned, up to this point, it's all about single Glidepath, and I've alluded multiple times to the fact that that may not be optimal. And here, another reference to the Department of Labor tips They say if the employees don't understand the fund's glide path assumptions when they invest, they may be surprised later if it turns out not to be a good fit for them. This is essentially referring to the situation back in 2008 that Cameron mentioned, where the difference between 2010 dated target date funds was over 30%. So could you imagine being, yourself invested in a 2010 fund that lost 40%, but your next door neighbor, also in a 2010 fund of a different series, lost 10%. That's confusing to a lot of participants. Wait, what do you mean? We're invested in the same dated fund, we're retiring at the same time. How do we have such drastically different results? And it's because participants just don't understand the assumptions that go into these glide paths and how different they can be. And it creates what's called misfit risk. So misfit risk is when a participant's characteristics don't match up with the assumptions of the target date fund company. And I want to boil it down in this example to savings rates in particular. So why savings rate? Savings rate is the primary determinant of a participant's funded status, the funding adequacy, which we mentioned earlier, which determines how much risk they need to be taking. So if a participant is saving less than 6% generally, they need to be on a more aggressive glide path because they're not saving enough. Vice versa, if you're saving more than 10%, you need to be on a more conservative solution to adequately protect the capital that you're investing. If you're somewhere in the middle, you should be on a glide path that's more moderate in design. So that's sort of the philosophy from a funded status standpoint, and that's the theme we've been talking about, all call. But here, think about it. If this was the breakdown of savings rates of participants in your plan, how would you accommodate this sort of diversity? And honestly, this isn't even that diverse of a plan. But even in this example, it presents some really unique challenges. Let's say, for example, the average deferral rate of this plan, of this breakdown, was 7%. You might pick a moderate glide path to accommodate your average participant, but you'd be leaving out 75% of your participants. The 53% that should be on an aggressive solution and the 22% that should be on a conservative solution. And it's those participants, that 75%, that would be exposed to this misfit risk because they don't have a glide path that fits their needs. So yeah, they may be surprised when they, don't end up with an account balance at retirement that they were expecting because of this misfit risk. Vice versa, you might look at this chart and say, oh wow, 53% of my participants are deferring less than 6%. Well, I should use an aggressive solution to accommodate that 53%. In that case, you'd be leaving out 47% of participants that would be on a moderate or conservative glide path. So, the wheels are probably spinning saying, okay, well, how do I accommodate this sort of diversity? And the answer, quite simply, is with multiple glide paths. And this is really, the customized solution that tailors it now down to a participant level. So instead of boiling everything down to an average savings rate, an average plan balance, average withdrawal patterns, etc., you can offer multiple glide paths, usually an aggressive glide path, a moderate glide path, and a conservative glide path, and allow participants to actually select the glide path that's a good fit for them. From a funding adequacy standpoint, from a willingness to take risk standpoint, and from a fiduciary standpoint, what that allows you to do is potentially enable 404C protection to kick in because you're not mandating or selecting a glide path for the entire participant base. You're letting the participants decide. So that's a really big difference with this. It's tailored at the participant level with this sort of solution rather than at the plan level like it was in version 2.0. The other aspect Similarly to version 2.0 of best-in-class managers, version 3.0 would actually take this one step further, where instead of being limited to just funds that are included in your plan lineup, you'll be able to go outside of that as well to really make sure it's completely unlimited and optimal. And ideally, you probably have some non-core asset class exposure in there as well, because from a risk-return standpoint, having some of these non-core asset classes in the portfolio can really make for a better risk-return profile. So this is a general framework of version 3.0 or a multiple glide path target date fund solution. So here, as an example, we have that same chart of all the different glide paths that exist. Instead of creating one glide path to fit your plan, you'd actually have 3 different glide paths to accommodate the diversity, the green being aggressive, higher equity exposure throughout, the conservative and orange, lower equity exposure throughout, and the moderate somewhere in the middle. And then from an underlying fund perspective, here's where, you not only take those standalone funds that, you include in your plan, like some of these core asset classes, domestic small cap, international, fixed income, but you add some others like global REITs, commodities, TIPS, some extended asset classes that have the potential to add some real value. So just some other advantages of this version 3.0 structure. It is unitized. So I mentioned, that unitized structure is really important. Version 1.0 off-the-shelf target date funds are unitized. You lost that ability with version 2.0. Version 3.0 brings it back. Custom solution, but still unitized. So simple, easy for all parties involved. Collective buying power. This gets back to the costs. Unlike version 2.0, version 3.0, due to its structure, leverages economies of scale and allows this sort of customized solution to be available to plans of any size for costs that are in line with what you get out of an off-the-shelf version 1.0 target date fund. So a custom solution without the additional cost, extremely compelling situation. Portability across record-keeping platforms, so you don't have that restriction, as well as access to funds outside of the plan lineup, as I mentioned earlier. So really, it's a lot of the benefits, the customality of version 2.0, but even more custom without a lot of the operational restrictions that came along with that.
And these 4 advantages really come because of the collective trust nature of this version 3.0 that we've seen out in the marketplace. I saw on the attendee list that there was a lot of 403B plan sponsors, and unfortunately in that environment, you're not able to use collective trust. So something else we've seen is, almost call it version 2.5, and some different, it is maybe specific to some providers out in the marketplace and not to others, is providers in that space using what's called a synthetic QSIP. So it's basically a custom model where they're able to unitize the model, leverage the same collective buying power from that specific party who's offering the synthetic QSIP. So it's not economies of scale across the entire economy just for those platforms that offer it. And you lose, I guess there's still a disadvantage with 3 there, point 3 where it's not portable, but you can access those funds outside the plan lineup because it's in a synthetic QSIP, it's unitized, and there's collective buying power, maybe to a smaller scale. On the collective trust side, this just allows to take that same concept and apply it across the entire industry. So the industry is trying to solve for that in the 403B space as well.
Yeah, that's a great point, Cameron. Thank you. So just to recap sort of this discussion on custom solutions, we have version 1.0, which are your traditional target date funds. The main benefit there is they're unitized, really simple for everyone to handle. Some of the pitfalls are single glide path and single manager. Version 2.0 is that first custom type solution, tailored glide path to the plan, but still just one glide path, but you have multiple managers involved, which can be really beneficial. But one glide path, non-unitized structure with some investment limitations. And then you have version 3.0, which is a multiple glide path structure, so it's tailored at the participant level. It's unitized, has multiple managers and uses a completely open architecture underlying fund structure, so there aren't the same investment limitations that you have in version 2.0. And if you kind of look at, behind the lettering here, the message is version 1.0 is really a solution that was designed to, fit kind of, or a solution for everyone. It doesn't get into really tailoring it at all. Version 2.0 would be a solution tailored at your plan level, so definitely a big improvement. And then version 3.0 is something that's really tailored at the individual participant layer for your plan. So some other key takeaways, just recapping sort of everything that we've talked about today. It's important to understand what your fiduciary duties are. I highly encourage you to go to the DOL website and read through the Department of Labor tips to fully understand what those are. Of course, referencing the main points that were discussed today. Two, the prudent steps, whether it's the exact process we laid out here for you today, or whether it's something that is very similar. Make sure you're having a process in place that makes sure you're checking the boxes for all the duties that the DOL lays out for you. And then step three, custom solutions. Make sure you're considering this for your plan. It's kind of rare that the Department of Labor says, you should do this, and that's exactly what they're saying. So make sure that somehow in that process you're considering a custom solution and documenting that you've considered that sort of approach. So with that, that's kind of the three big key takeaways for today. I'll turn it back over to Cameron here for a brief conclusion.
Yeah, so thank you all. And again, the last thing I'd like to leave you with is, again, on the custom solutions, even 3.0 might be limited to some of the platforms you're on from a group annuity standpoint that can't offer a collective trust. So again, it's going to be all dependent on your specific situation, what works, what's available, what doesn't. But hopefully you left today with a bit more of a framework that you should be analyzing, especially the fit portion of the target date. That's a little different than any other investment option. And also get an idea of what is out there in the marketplace and what the industry is trying to do. So with that, I'll hand it over to Kelly to see if any questions or housekeeping items.
Well, I'd like to remind participants, if they do have questions for Cameron, they can use the question and answers pane at the bottom of their screen. At this point, I'm not sure that we have any. I know Cameron will be reaching out to all of you, thanking you for your attendance, and so you could send your questions to him privately after the webinar as well. I would say in the next few days. Cameron, you were going to send your presentation, I believe, if that's correct.
Yep, I'll be following up with a PDF version of this too. And again, if you have any questions or just want to talk through the specifics of what you currently have, and if you want to learn more about the fit analysis, we're happy to take any questions, both Kellen and I. So thank you.
Okay, wonderful. Thank you both, and thank you, audience, for joining us today. Please check out our website for future webinars, and we certainly invite you to join us for one of our conferences in 2016. With that, we'll conclude the webinar. For today, we'll have a brief survey that will pop up once we end the webinar. But again, Cameron, thank you so much. Thanks for the great information.
Thank you.
Hope everyone has a great day.